Thanks everyone. So today we're going to talk about M&A and how do you basically position it as a growth strategy? We've got folks from different spheres here. We've got an investment banker, that's Armen. We've got an operator who's been acquired, which is, Alex is a lawyer, and Arsen is the operator who got acquired. So a quick introduction of everybody here. I'm just going to very quickly read on this. So Arsen Babayan, seasoned technology leader, former site leader, director of engineering at Adobe in Armenia. And Adobe was the company that bought the company you were working for, right? So that's what the M&A that you went through. So he led the Erevant's office, engineering operations, global product development initiatives, and he has 2 decades experience in software engineering, etc. He's at Ineco Group now, and he leads digital transformation and innovation across the group's financial services portfolio. So that's Arsen. We got Armen. Armen came in from, so Arsen's local. Armen came in from France, from Paris. He heads Celimene. It's an independent M&A firm based in Paris. Over the past 24 months, they've successfully closed deals across 4 continents, and they focus on healthcare and technology sectors. And also does a lot of startup work and his own entrepreneurial side things too. So thank you guys thank you for making the trip, Armen. And Alex is from Los Angeles. He's from Latham and Watkins. He's former co-chair of Latham and Watkins Los Angeles corporate department, advises clients primarily on mergers, acquisitions, venture capital transactions, public and private securities offerings, and general company representation. So he's done a broad range of domestic international businesses, including numerous clients in internet, digital media, e-commerce, software, entertainment, etc., etc. I think one of them was MySpace as well, right? For those who remember MySpace, the precursor to Facebook. Okay, so let's get into it, guys, and myself. So my background, so from an M&A perspective, I've exited 3 companies, so been acquired 3 times. I've been the main lead of acquiring 4 companies, so been through that. And also been part of the teams that acquired companies a dozen times. So some experience there too, but these guys are the experts today, and so let's get to it. So guys, M&A is very, it can be tricky, it could be fun, it's a lot of very stressful. So can you each give sort of like one of your most memorable, most exciting experiences in M&A? And maybe we can start with Armen.
Sure. I will talk about my first experience as a young investment banker. And it was a very deep experience for me because we were working sell side for an amazing company that had this world-class medical technology. So a couple of transactions had taken place in the prior years for $200 to $300 million in this area. It was a technology that was a total disc replacement device. So we were extremely confident for the deal because we were sure that our technology, the company that we were advising, had a better, much better technology than its peers. But what happened is that this other technologies that were previously approved by the FDA convinced the CMS, the American Health Authorities, to stop reimbursing this category of technologies. So that was a very interesting lesson early on. You can have the best technology in the world, and it can have a huge impact on people's life, but this is still not enough. The environment is also key in M&A.
So by removing that from being subsidized or basically being part of that class, their revenues obviously get affected by that, right? And that's one of the reasons that changes the landscape. Very cool, very cool. So thank you for that. Arsen, your most memorable experience?
As like Armen, I would actually like to remember my first experience. I went through an M&A as an employee. I was first time in my life when I got employed, I was employed by a company called HPL, which 3 or 4 years into my employment got acquired by Synopsys. And what struck me back then, and these feelings are still alive when I'm kind of reflecting back, is how not really resistant, because you can't resist that force of being acquired from that position, but how cautious and how negative employees of HPL sometimes seemed to be towards that process of M&A. And these feelings and the analysis of those down the road basically shaped my overall approach to M&As, because people in the company which is being acquired really undergo this difficult process of switching their identity, switching their sense of belonging to the new company, essentially switching their allegiances and loyalty. And that's pretty difficult process for the company that's being acquired. And unless the buyer company can really understand and work with those processes, at the end of the day, the problems that will actually be caused by these people and culture-related problems can really hurt the synergies that they're targeting.
Yeah, that's a great point. There's a lot of activity out there that fail after an M&A, right? Like companies buy companies sometimes for billions of dollars, and there's no culture fit, and it was not well assessed at the beginning, and the whole integration process fails, right? So that happens a lot, right? It's very hard to pull off successful M&A. So speaking of successful M&As, Alex, any memorable experiences you've had? So Alex just does M&A as well, so.
So I won't talk about my first M&A deal because I don't remember what it was, and it wasn't very memorable. But you sort of stole my thunder. So this year is actually the 20th anniversary of this particular deal. I had a client, it was named Intermix Media, and it was a publicly traded internet company, which is just a conglomerate of various internet websites. And the CEO, who was a friend of mine, came to me one day and he said, we have this little website called MySpace, and I don't know if people remember MySpace, but before there was Facebook, there was MySpace. And the 3 of my employees started it, and someone drafted these documents, and they say that they each have 1/3 title in the assets of MySpace, and we need to like clean this up because I think it's going to become a bigger thing. And I was like, what does it even mean to have 1/3 title of a website? Like, it's not a house that you jointly own with your wife or anything like that. So we ended up forming a C Corp, having these guys contribute their 1/3 interest in the assets of MySpace to the C Corp, and we had a venture capital firm come in to fund it. So we had this parent company that owned 51% of MySpace, but it was starting to take off, and we said, we want the right to buy the 49% that we don't own if we get an offer to acquire the parent company within 12 months. And then literally like 2 months later, MySpace took off and became like the biggest social media. I mean, it was new, there was no social media at the time. And lo and behold, my friend comes to me probably 20 years ago today and says, I just shook hands with Rupert Murdoch. He's going to make an offer to buy the company for $580 million, which doesn't seem like much today, but at the time it was quite a bit. And he wants to have the deal announced by Monday morning. I'll spare you, this was on a Thursday, and I was like, okay, I've heard of deals getting done in 48 hours. People always brag about it, but nobody actually does it. And I also had my 20th high school reunion a couple days later, and I was like, I don't want to miss this. He's like, oh no, don't worry. Like, Rupert said it has to be done by Monday morning. So literally, there's a lot to this story that I don't have time to tell, but we got in a conference room. Lawyers for News Corp flew into Los Angeles. They drafted the agreement by hand on the plane. We had someone typing it up, and sure enough, by 5 o'clock Monday morning, after sleeping under conference room tables and so forth, we signed a document that was literally like a handwritten markup of a merger agreement. So there's a lot more to that story. There's actually a book written about it called "Stealing MySpace," but it was probably one of the more fascinating. But that one only gets an honorable mention. I get to talk about 2 deals. A couple years before that, one of my partners in San Diego, who did not do emerging companies work, said, who was Armenian, said, I have an Armenian friend who is an entrepreneur and he's starting this company, would you work on it? And I was like, okay, sure. So we formed a company, pretty simple. It was called Creation Point. And I think they pivoted 2 times, 3 times, but eventually, after many pivots, were sold in a very successful exit transaction to VMware. And that person who I met, I was introduced to, is sitting in the front row right here, Al Isayan. And I talk about it not only because it was a super memorable deal, but it led to a 25-year plus relationship with Al, who's a very well-known entrepreneur here, and it led to me coming here. This is my 2nd time, and I love it, and I'm probably the only non-Armenian up here, but so those are my 2.
I mean, that's true. The relationships you build during an M&A process, by the way, are crazy. I'm still very close friends with my first investment banker and the first legal partner of the firm. Close friends. Like, he was at my house last Saturday. And I've worked with them with all 3 acquisitions, so it's crazy that that's so common it is in this, because you work so hard together to get to a point, and you basically become friends, right? So anyway, that's a great story, great stories, guys. Thank you. Let's jump into another topic here, and that's the one of, should founders go seek out to be acquired, wait for someone to come acquire them? Like, is this a science? Is it an art? And also, when do you start a sell process, right? And maybe we can also define a sell process. So maybe, Armen, you want to go first at this? And then, Alex, I'll call on you to add.
Sorry, ask the question again.
So, with the founders, should they seek an acquirer?
Yeah.
Or should they basically wait for someone to come acquire them?
Yeah, no, for me there is no question. You have to be proactive. Waiting for the great acquirer to show up magically is like waiting for your soulmate to ring on your door the very day when you are ready for a wedding. So it's not something that I would count on. And let's imagine even that does happen, right? You have this great acquirer that shows up, and you think it's a good moment. Let me tell you just a few things. Number 1, I think that even that happens, you got to be prepared. This is possibly the most important moment, the most important transaction of the life of the company, potentially of your professional life. So this is not something to be improvised. Number 1. Second, if you're engaging in this process, it's very demanding. You got to talk with several guys, not just one guy that show up. Yeah, you have to create at least some kind of competition to get a better deal. And by the way, I would preach for my own cause here, but you want to have an advisor at your side. I think that it's not by accident that very often acquirers might approach companies and ask a couple of questions innocently, like, am I the only one discussing with you? Do you have an advisor? This is not innocent. If they know that if the answer is yes to both questions, then it means that the deal will be, in all likelihood, better for them and worse for you. So definitely, I think that typically the optimal transactions are those who are discreetly but seriously prepared.
Thank you for that. And I'll add to that too, the importance of investment bankers, and I'm not an investment banker, but I'm just telling you, just going through it, it's also the middleman. There's a lot of emotions and a lot of things that happen in an M&A process. So you don't want to be the one telling someone to go fly a kite, as an example, because you will be in situations where you're playing a game of, no, I'm walking away or not. It gets there, right? So you want someone doing that for you, because don't forget, at the end of the day, when the acquisition's over, you have to live with the company that you just acquired and the company, or vice versa if you're in the other role. So you don't want to be the one having those challenging discussions all the time. The investment banker does that for you. They're great at that, right? So thank you for that. That's great insights. Alex?
Sure. So I would say, obviously, when you form a startup and you have to turn it into something that people will want to acquire, the focus should be on that, not on sort of, starting a process too early, because you want to make sure the company is sufficiently mature that you're going to get an attractive valuation and so forth. But by the same token, and I agree with what Armen was saying, is at some point, you also don't want to start a process too late. So for example, 3 years ago, if everyone remembers, NFTs were huge. These companies were raising money at billion-dollar valuations. And today, people are like, what is an NFT? Why would we buy a piece of... And right now, AI is the rage, obviously. I think AI is probably a little bit different. But every 2 or 3 years, it seems like something else is hot. And if you wait until whatever you're doing is not hot, you're not going to get the same valuation as you would have before. So I think it's important not to start too early, because as Armen said, it's a very time-intensive process. It takes the attention of all the senior leadership of the company, but try to time it right, and don't be greedy. Don't think that this wave is going to continue like a hockey stick, because eventually it's probably going to come crashing down, and then you might not even sell enough to get your liquidation preference back. So.
Absolutely. To that point, there's a lot of cyclical variations to multiples that people will pay for your company. With the same company making, let's say, 40 million a year of ARR, could be, 10 times that worth, because they're part of a market that's growing and there's a wave going on. And when that wave goes away, that 10x multiple might actually be 4x or 5x, right? So your timing is very important. Even though you're doing nothing wrong, you're running the company amazing. You have to also judge it with the markets, if there's that wave happening, right?
Yeah, so. And one other thing, I completely agree with Armen that you should consult with investment bankers, but there will be times where there's a natural acquirer for your company, and it might be Amazon, or it might be, and they'll just come to you and say, if you hire an investment banker and run a process, we're gone. We don't have the patience for that. But we're going to offer you this super high preemptive price. Still consult with the banker, but you may decide it's not worth taking the risk of losing that deal and running a process, because that's sort of the bird in the hand. But either way, I highly encourage you to have an investment banker, because they can tell you, no, there's 4 other companies that will pay this much or more.
Yeah, Alex, let's continue. Another topic. How can founders design their fundraising strategies so that they have optionality during exit?
Well, my answer will be from a lawyer's perspective, and then you guys can chime in from a business perspective. But I can't emphasize enough how important it is to get the simple things right. When you form a startup, you obviously don't have any money. The last thing you want to do is spend money on lawyers, certainly not on very expensive lawyers. But I've been involved in so many deals, for example, where there's 4 people that had an idea, and 3 of them went and formed a company and left the 4th person out, and that person has a claim, down the line when there's an M&A deal that, hey, I actually started this, I should have had some of the equity. So you really want to make sure that your cap table is clean, that you don't have service providers that have created IP that haven't assigned it to you, etc. And just little things like making sure you're issuing stock options correctly or making tax filings correctly. These things all come up in a diligence they will come back to haunt you in a diligence process for an M&A transaction, and it'll affect the price that you can sell the company at, or it'll affect how much exposure you have post-closing to claims by the buyer. So a little bit of investment up front on things like this, it's painful because I work with startups all the time, so I know how limited the cash is, but it's so much more expensive to fix a mistake later, and the consequences of a mistake can really have impact on valuations later on.
Thank you for that. I'm going to talk about a different aspect of this, which is if you've raised money and how it can affect your optionality of exit, right? So we see a lot of companies, especially during these times, like AI, where the valuations are skyrocketing, right? And I'm a big believer that, you obviously want the best valuation for the company, but you want the right valuation, right? So I see a lot of companies go for huge valuations that they need to grow into, which is like very hard to do if it's really, really high. What ends up happening is afterwards, because the money was put in at those valuations, sometimes you might get a deal that, might be great for you. Someone wants to buy your company for $200 million, right? But then when you raised money, the company was actually valued at 150, even though you were making, let's say, 20, 25 million of ARR. Guess what the investors are gonna do? They're basically gonna say, let's not sell it yet. They need to make money too, right? So right sizing the valuation, not always going for the highest valuation when you're raising money, is a really important thing as well to do. That can really block an exit for you. It's happened many, many times where people thought, that's it, the most important transaction in my life is happening, and then they got blocked by their own investors because they have their own plan of how much money they need to make with their investment that they made. Let's jump on to the next one. Arsen, let me call upon you. So, beyond technology and talent, what are the underestimated factors acquirers really look for? Like customer contracts, recurring revenue, like culture we were talking about. Can you share some of your experiences, insights on that, please?
Thank you. Talked about the culture. In my opinion, culture is kind of the butter spread on every synergy that you want to achieve with the acquiring company, basically. So it's something that needs to be taken care of from day one. However, I believe I don't think it's underestimated. What I think is underestimated, and especially from the founder's point of view, I very seldom see the founders actually positioning their company for acquiring from the position of customer space. Not necessarily customer contracts, but customer space. A good example is what Workfront basically did before being acquired by Adobe, is Workfront positioned itself with the same companies within the same industry as Adobe has been doing for years. So there was this very natural synergy between Adobe and Workfront, a long-standing partnership, and you may say an inevitable acquisition pretty much, because on the customer's level, those two companies were providing solutions which were elevating each other for the customers of both Workfront and Adobe to solve their problems. I think this can be applied both to B2B markets and B2C markets, but it's pretty much predictable and can be worked on by the founders if they are in a B2B business, especially if they're eyeing to be acquired by some larger player in the market for vertical integration. So this can be taken into account from day one if the target is to exit through acquisition.
Thank you. Armen, any insights on this one?
No, I just wanted to get back to Alex's point. I think as a founder, you need to understand your acquirer strategy, and because there can be a million reasons why an acquirer would want to make a deal with you. So some some companies want to acquire for the team, others couldn't care less about the team. Sometimes it's just about acquiring a technology. Sometimes you have you want to invest to support the growth and then sell your stake for 10 times higher and so on. So, so there can be a million reasons, but your job as a founder is to understand your vertical, to understand who could be your natural acquirers, what is their strategy, what they would value in you, with you, and who would be the better match to optimize your transaction and make sure that the company has a great journey to go.
Sometimes you can, I'm sorry Alex, you wanted to say something? Sometimes you can actually adjust your price according to that too, right? Like once you understand what they want to do with you, you might see that it has way more value than just the multiple of your ARR, and you can adjust your price, right? So, if you're working with like top investment backers like Armen, like they'll do that. They'll help you with that, right? They'll say, you know, we can go get more money here, right? I have a little small story on this. Like the second company we sold was to Dell, and they had also a tax situation that we were helping them out with that we weren't aware of. And because they acquired us, they got a huge tax break because of a Netherlands law and something. And we could have charged 40% more for our acquisition price, and they would have probably still gone for it, but we didn't know, right? And so, but that's hard, right? But those situations happen. I think understanding your acquirer's reasons can definitely help, you know, optimize your price.
Yeah, and one thing that comes to mind in connection with that is when an acquirer is looking to acquire a company, not just for its business, but for the team, particularly the executive team, there are a lot of acquirers who are super aggressive, and they will say, okay, we're going to pay whatever, $1 billion, but the founder and the next 4 people, your money, you have to basically subject your proceeds to essentially revesting. Even though you've worked at the company for like 6 years, you need to actually earn that back over a 4-year period. That's the best strategy from an acquirer's perspective, but you may have another offer where there's, they're offering a similar or maybe slightly lower purchase price, and then doing what they should do, which is actually put on top of that an incentive package to keep the management team around. So there's a lot of like nuances here where the headline price can mean something to the investors, but something very different to the founders of a company, because if you have to basically re-earn what you already own, it's clearly not as attractive as actually getting paid for what you own and then re-earn some money or earn some money on top of that through a retention plan.
Yeah, totally. Arsen, what was the reality like post-acquisition? So, let's say the folks here, they're starting a startup, like what should they expect if they get acquired? You've been through it. Tell us a little what you think about that.
In a lot of cases, in which the post-acquisition integration goes in a more or less substandard way, as I believe, is that the company that gets acquired adopts a very passive stance for integration. That's what I'm seeing, and I actually believe that this is the reason behind so many failed acquisitions where the synergies eventually do not realize. We have so many examples even in Armenia. I think from the founder's perspective, and to Alex's point, very often the founders and the next 4 people have to stay with the company for some period of time. They need to actually adopt this more active stance of getting integrated with the acquirer, because in many cases for the company that's acquiring, the deal is a bet that they can actually afford. from the founder's point of view, this is the fruits of their work for many years. This is probably one shot at getting great, so to speak. And in my opinion, they have bigger skin in the game to make this work.
Yeah, totally. And so, there's a lot of, when these acquisitions happen, most of the time when they fail, it's really because of the acquiring team and how the culture and how they treated the company, and this is all related to that. I'll talk a little about.
I was just going to say, I completely agree. There's so many acquisitions that happen where the team that gets brought in that's used to sort of a startup's culture and high risk, high reward, now is just earning a salary and they're bored and they're just like, we're not going to do this anymore. And so from the acquirer's perspective, you want to set up a plan that makes people want to stay there, makes it exciting, makes it financially rewarding, because otherwise you just bought something that you're going to have to then run yourself because everybody's going to
totally. And so I've had a few experiences. The first one is really the hardest one, the first time you go through an acquisition. But typically, when they're trying to acquire you, will present, this is what you want to do with them, this is how the roadmap's going to look like, etc. Chances are everything's going to change once you get acquired. That's literally what happens. So I've seen a lot, I've done it myself, where you resist change and you're like, we're still the same company, right? But you're not anymore. That's one of the things founders need to understand this day they get acquired. You have to be at peace that you exchanged ownership of this company. It's not yours anymore for money or however they bought you, right? And that makes things easier, honestly. Once that's in your head, psychologically, it makes it way easier for you to basically go through the process of integration and so forth. But as a founder, having worked on your baby for so many years, it's very hard to do, especially the first time. Second and third time, it becomes easy. It just basically becomes more transactional. The first time, it's very emotional. So, that's been my experience, on that front side, which I think was more of a founder issue than an actual acquirer issue. So, last question before we get on M&A, on Q&A, sorry. So if you had one piece of advice to give to the room, what would you give? Arsen, should we start with you?
Sure. I will tie back to how I started this panel. What surprised me most, I think, still remains the most underexplored aspect of M&As, and that's people and how their belonging, how their allegiances actually chart out the post-M&A integration process. So if it's one piece of mistake, everyone going through M&A, pay attention to the people aspect, pay attention how the cultures gel, and yeah, if you're the member of the founding team, just make sure you keep the initiative for the integration. It's not going to happen just by itself. This is a two-way street, that's it.
Alex?
Yeah, I would sort of tie back to what we've been talking about a little bit, which is don't be overly greedy. So, and there's a lot of situations where I think this applies. When you're doing a financing and you're in the middle of a crazed world and valuations are skyrocketing, and you don't take money because someone's offering you $10 million at a $100 million valuation, but you think it should be a $500 million valuation and you don't want to incur that additional dilution. Again, 2 years later, 6 months later, there may not be any offers. You may not be getting in the funding. And so if you own 20% of owning 20% of a $1 billion company is a lot better than owning 40% of a $1 million company. And I see it very often that people just they think there's no downside to turning away money. And startups need to make sure they've always got enough runway, because once you run out of runway, then all the leverage is gone in terms of bringing on investors. And the same thing applies to when do you do an M&A transaction, which as I said before, is don't don't wait because you think you're going to be a $5 billion company. I have a roommate of mine in college, and he and his wife founded a company, and 5 years ago there were investment bankers telling them they could sell probably, if they waited a little while, for billions of dollars, and today they'll be lucky if they get $100 million. Obviously optimize everything to the extent that you can, but don't wait for the peak necessarily.
Right. And Armen?
I see many founders that look at M&A as something a little bit remote. That is a bit distant to them, and that is probably, and they usually think that the time will come when they can start getting into it, but they don't need to look at it now. I would say just try to understand your market and understand how things work before M&A comes to you, basically. These are that can be very critical transaction. As you said, these are also very tough moments, very emotional moments, and it's much better to get accustomed a little bit in advance, to understand what's going on in your market, to understand what are the acquirers' strategies and interest, and to try to make yourself basically to make both actually your company and yourself ready to make the most of the window of opportunity when it comes.
Well, thanks. A huge round of applause for our awesome panelists.
Thank you.
That's 2 days in a row. We're doing great on time, by the way.
Indeed,
and
indeed.
for Raffi.
I just want to point that out.
Yep, it makes sense. Raffi, we still can grab some questions from the audience.
Q&A, yeah.
Yeah, Q&A session. So
Also Raffi as well.
yeah, we have a question here. The microphone.
Thank you so much. As an HR and recruiter specialist, I would love to know about your thoughts about if the M&A process is based on the talent pool that the one company needs, the exact talent pool for another company, and the needs of an M&A is that. So, how you can do that a bit more ethically, or if you have some kind of this type of deals, how you deal with that? Thank you.
Did you guys answer? We didn't quite understand the question.
So if the need of an M&A, so merging two companies,
Yes.
is the talent pool for another company. So an
acqui-hire.
Yes.
Okay.
Yeah. So how you can do that a bit ethically, so the one company or the hirees or employees for the second company didn't notice that it's because of them. As Mr. Voxman said, that basically there is type of M&As that you need see management of the other companies. So if the need is not only the business and people, so how you manage it?
Who wants to take this?
So basically, how do you have a successful acqui-hire? Is that
on a talent level, on a human perspective level? I'm here, as I could guess from the colleague question. The thing is that very, very frequently when there's a merging of the companies and one company merges the other, or the acquisition takes place, there's a psychological way of thinking that those are the ones who are guilty for our company no longer exist. I personally myself happened to be in a bank which was acquired by another bank, and there was this interesting psychological thing because some of the team had to leave because you cannot hire all of them, and there was the ones that who stayed started to have this kind of a blaming type of a culture towards the other bank that acquired them, because before that the life was wonderful. So I guess this is probably closer to that. Yeah, okay.
So I guess I have a couple thoughts, but the one is just in terms of the structure of the acquisition. In an acqui-hire, the acquirer doesn't really care if the other stockholders get paid anything. They'd be happy to buy the company for $10 million and pay the talent, the $1 billion or whatever. But obviously your investors are not going to allow that. So you're going to have some balance. But I think that I think the most successful ones are acqui-hires where, whether it's revesting, which is painful, or just a new sort of incentive plan that's geared towards the acquired company that actually has a lot of meaningful upside. One example, this is many years ago, but when Tencent acquired Riot Games, Riot Games has League of Legends, which is the largest multiplayer game in the world. They assured the founders that they were going to operate it as a separate subsidiary, where they would still have full control over everything. And in fact, they left some of the equity with the founders, and we had a very complicated structure of puts and calls as to, if the valuation increased. And I was highly skeptical of that. I was like, they're going to own 90% of your company. They can do whatever you want. But they actually did what they said that they were going to do, which let it operate as a completely separate entity. And as a result, the Riot Games has continued to just flourish in the now 15 years since it was acquired by Tencent. And it's really is its own company. I still represent Riot Games, and I'm constantly negotiating with Tencent, even though Tencent owns the company on various things. So I think that's another model that can be very successful. Now, the flip side of that is, that's a sort of an outlier example, but you're going to have pressure from the parent company. They're going to see, their employees are going to say, wait, you just acquired this subsidiary and you're paying these guys all this much and we work for this? So there's a lot of complexity and dynamics there.
Thank you so much.
Indeed, thank you.
Other questions?
Do we have any other questions coming from the audience? If not, then if I may use again my status and come up with one more question. I'll address my question then to Arsen Babayan from Ineco Group. Arsen, if you could refer anything specific when it comes to M&A processes, when it comes to Armenia, anything specific, the market size, the relationships, anything that you could refer. I'm sure you have had some experiences. That would be just not probably very unique towards Armenia, but something that is worth mentioning.
I've been through two M&A processes where I was on the side that's being acquired, and I can say
interesting.
I can say it's pretty hard on our culture actually, because there's strong bond within employees.
Exactly.
And every time someone has to leave because there's talent surplus after M&A. Just the question that was asked before, right? I think what works in Armenia is certainty and clarity. If people know that what's being spoken is the truth, in my experience, no matter how harsh the truth is, they can back that up, and they can understand that, and they can work with that. Unfortunately, much too often than I would like to see, that's not being done in that way. Sugarcoating, concealing information, with good intentions, but people are not being put in well awareness of what's going on, what are the new expectations, why their colleagues left, how they were treated, and so on and so forth. So if I summarize, I think in Armenia there are two sides of things, which two sides of the problem that needs to be taken care of. It's the treating people respectfully, especially those that leave, and securing clarity for everyone who stays. So that's pretty much it.
Thank you so much. So it means that the communication matters, the way you communicate it.
Absolutely.
How about, Arsen, how about the trust? Because I know frequently we just, the way we always find solutions sometimes also brings, the other side, which is related to the mistrust. Sometimes in Germany you might go and shake the hands, and without even a paper agreement, you're sure that you shake your hand and the agreement is there. It might not be the case in Armenia. Just a bit more of elaboration on this if you had the experience. It's not about that we do not trust each other, but the trust issue, because we always try to find the B option, the C option, the D option that could be possible to carry out. At the end of the day, sometimes just a simple trust doesn't work. Simple trust between teacher and the student, simple trust between the partners, simple trust between the ministry and the population. So I would also ask, if possible, just from the business perspective.
So I deeply believe that clarity and transparency are the main ingredients of long-running trust. Whether that's relationship between two individuals, whether that's relationships between businesses. Of course, trust is much more complex. It has roots in some cultural aspects, how people behave in the community, on all that. But I'm a firm believer in general that people are more alike than different wherever you go, whether that's South America or Armenia or Russia, anywhere. And my recipe for trust is clarity of intentions plus transparency of actions. Let's put it that way. That's probably 80 to 90% of what trust is made of.
Thank you so much. You wanted to elaborate, or? Yeah, thank you very much, gentlemen, for the wonderful elaboration on the topic, and Raffi, thank you for the moderation.
Pleasure.